Hello, good morning, everyone. Welcome to our Phillip Research morning call. Today we got quite a few number of counters, so we're gonna try to rush through a little bit. We got OCBC, we also got ComfortDelGro, Sheng Siong, Raffles Medical, PropNex, ST Engineering, and as usual, we have our technical analysis and SG Weekly. So just a quick flash of our disclaimer. So everything was only for educational purposes. So without further ado, I'll pass my time to Glenn to start with the SG banks.
Hey, thanks, Elena. Yeah, so we start off first with OCBC, who released the last Singapore bank to release their results. We titled it Earnings Miss from Higher Allowances and Expenses. So, that really is what caused their fourth quarter earnings to fall below our estimates. And their full year PATMI was at 96% of our forecast. Dividends wise, their final dividend did dip slightly by 2% year on year to 41 cents. And the FY24 dividends but the FY24 dividends was still higher at $1.01, mainly due to this new special dividend of 16 cents, which is part of their capital return strategy. So I'll touch upon that more later. What really moved the earnings, the positives wise, it was just the wealth management fees that continued to rise. For FY24, if you look in whole, their total wealth management income did grow by 13% year on year, and also contributed a larger amount, 34% to total income, as compared to 32% a year ago. For the AUM, it was also 14% higher. It was driven mainly by the continued net new inflows, which was around 21 billion for the year. The trading income was also continued to increase. It rose 37% from the higher customer flow income, and also the main driver for non-interest income growth, which grew around 18% year on year. As for the negatives, the first negative is that their net interest margins, the compression has continued. So it dipped to 2.15% in the fourth quarter compared to 2.29%. So it dipped by about 14 basis points from a year ago. Loans growth was quite healthy at around 8% year on year. But if you put in the two together, net interest income was flat for the year. Moving forward, OCBC is expecting 3 rate cuts, so they have modeled in 3 rate cuts, totaling 75 basis points in 2025, and they're guiding for around 2% for FY25 NIM. So we believe that this is quite low, quite a prudent guidance, and we do expect it to come in a bit higher at around 2.05% for 2025, and for loans growth to be able to maintain the net interest income as the NIM continues to decline. The second negative, which is what was in our title, was that the allowances and expenses have both increased and rose. The higher allowances were mainly due to the higher specific provisions from an increase from one Hong Kong commercial real estate account, which was downgraded. But OCBC did not see any other significant stress in the rest of the sector. But if you look at the total credit cost, it was quite stable at 21 basis points. For the expenses, it was broad-based and resulted in the cost to income ratio rising by 45 to 45.7%. This is quite a significant increase from the 40% the previous year. As for the outlook, they have guided for net interest margin in the NIM in the region of around 2%, mid-single digit loans growth, as well as cost income ratio in the range of around 40%, low 40%. We do expect 2025, sorry, will be a rather subdued year for OCBC, because the higher expenses and allowances will really offset the gains that they get from the higher fee and trading income, as well as the loans growth recovery, which is around mid-single digit. So we only expect growth of around 3% for total earnings. For loans growth, right, we think it'll be quite stable at around mid-single digit, around 6%. Credit costs also will be coming in around 20 basis points. So moving forward, we really think that the fee income will be the growth driver for OCBC. They have continued to invest in their wealth management franchise. They have also, expanded quite aggressively and hired a lot of new relationship managers or RMs. So we have seen fee income grow by double digits. They have also continued to fully sort of put in fully envelop the PT Bank Commonwealth in Indonesia, and so we believe that this will continue its growth in ASEAN. We're expecting fee income growth around 14% for FY25, and this could add around 270 million to their revenue. And as I said earlier, this will be the main driver for 2025. For the capital distribution strategy, which I mentioned earlier, so it's around 2.5 billion over 2 years. And this includes a special dividend of in FY24 and FY25. So they will really pay out in FY24 and one more in FY25. And this will be equivalent to a 10% dividend payout ratio. So we're estimating it'll be around 1.5 billion. And share buybacks of also another 1 billion in FY25 and FY26. So if you maintain they are going to maintain dividend payout ratio at 50%, and on top of this 10% additional dividend payout ratio, we estimate the FY25 DPS to be $1.05. And with this share buybacks as well as the extra dividend, we roughly believe that it will drop down their CET1 to around 14.2%, which is still above their target of 14%. And with this, we believe that they will be able to continue with the special dividend for at least another 2 more years, so till FY27, as their retained earnings will continue to prop up their CET1. We do maintain and accumulate but with a lower target price of $17.90. And we also feel that this 6.1 dividend yield that they are paying is quite attractive, as they will continue to pay out 60%, or they have the capability to pay out this 60% dividend yield, the dividend payout ratio for at least 2 more years to FY27 to reach their optimal targeting range for CET1. Now, moving on to the next slide. Yeah, we will have a short recap or overview of all 3 Singapore banks since they have released all their results for the 4th quarter. So you look at the red box here, it's really the fee income that was driving the growth for DBS and OCBC. Fee income and trading income. For UOB, it was quite flat, for both for the non-interest income, it was quite flat. So net interest income was what drove UOB's growth. Allowances, if you look at right below the first red box, has risen for all 3 banks, and this is sort of expected as it comes back to a more normalized level. But and it came also mainly from the higher specific provisions. But the positive thing is that all 3 banks have very high management overlay. DBS is really the only one that openly says how much they have. They have around $2 billion of management overlay. So this is used to offset to sort of write back general provisions if the specific provisions come in too high, and the credit cost will then come in quite stable for the banks. I think the most interesting one that the investors will be looking at will be the dividend yield. So for FY25, this is our estimated dividend yield. We are looking at around 6.1% to 6.5% for the 3 banks. So this will remain very attractive for the banks, as we believe that all 3 banks will be able to continue to pay out more and return more capital, even past what they have previously guided, which is, I think, on average, is 2 to 3 years. So we believe that they can continue to pay out even more to come back down to their optimal target CET1 range. Yeah, so that's all for the banks. I'll now hand it over to Iqbal. Thank you.
Thanks, Glenn. I'll now present on next slide, please. Pan United's results briefing. Next slide. Yes, Pan United presented their second half 24 results. So for their results wise, all segments are positive. It's just that revenue and PATMI are below our expectations because we expected a slightly higher project takeoff. So revenue and PATMI was 94% and 97% of our FY24 forecast. However, their gross profit and EBITDA improved and is within our expectations. So the positive for Pan United is that they have higher gross and profit margins because of a higher mix of low carbon products. And they also have a much higher net cash to cushion the planned capex that is going to take place in this year itself in order to move their batching plant to Jurong Port. And they also have a higher dividend yield and payout ratio compared to last year. As for their negative, we do see a slower than expected project takeoff because, for example, a major project is Terminal 5. Terminal 5, even though it will start construction in the first half of this year, the construction will mainly involve groundworks and like digging the underground infrastructure and all those. The actual concrete work will come in only after August this year. So that is the negative of Pan United itself. As for our outlook, because construction demand is expected to remain at elevated levels for the next 4 years based on BCA's forecast, and Pan United with a 40% market share in ready-mix concrete, we do believe that is very well positioned to capture these elevated levels of construction demand. And the batching plant in Jurong Port will also serve as a barrier to entry because new entrants will need a much higher capex in order to enter the market. So we maintained our buy call and we raised our target price to 0.75 from 0.68 by adjusting our revenue and PATMI to reflect the slower project takeoff but higher profit margins, and also lowering our WACC to reflect a healthier balance sheet. Yeah, next slide, please. I'll be presenting on Hong Leong Asia's Phillip on the ground. Hong Leong Asia released their second half results. For those who are not very familiar, Hong Leong Asia has two main segments. One is the powertrain solutions in China that make up the bulk of their revenue, 83%. The second part of their revenue is building materials in Singapore and Malaysia. This forms a smaller portion of their revenue, 16%. As for their powertrain solution, growth is still slow in China. So as you can see, for the revenue of the powertrain solutions, it declined slightly by 1.3%. And the diesel trucks and buses market fell 2.6% in last year itself. This is because the government fiscal efforts actually is quite slow in boosting demand because consumers will be affected first before they decide to spend money to travel and the domestic tourism models. Yeah. As for building materials segment, around the same story as Pan United, the order book is increasing because of the uptick in the construction sector. And for third quarter this year itself, even though it is a small segment, precast, which is 15%, we do see an uptick in the precast volume because there will be a batch of HDB being completed. As for outlook for Hong Leong Asia, growth will mainly come from the building material segment. However, because this segment it only makes up a small portion of their revenue, we don't expect the growth to be very significant. And China, we do think that it will still remain stagnant because of the demand is still very slow over there. Yeah. Next slide, please. Next slide. Yep. Food Empire Holdings, Phillip on the ground. Yeah. So we also don't cover Food Empire, but they released their FY24 results. For those who are not very familiar, Food Empire is a coffee products manufacturer. So they have many different brands under them, and they sell their products to the different retailers, which will help to distribute their products to the consumers. So as for their production facilities, they have 9 currently, and they'll add one this year and one more in 2028. And their raw material is actually coffee. So as we all know, coffee prices rose more than 100% in the last year. So I think luckily for Food Empire, their brands are quite strong. So it helped them to pass on these prices to consumers. However, margins are being slightly compressed because of the high prices and cost of raw material as well. And as for their revenue, we see a 12% year-on-year growth because because they are able to pass on these prices to consumers. As for Vietnam itself, it is their highest growth segment in terms of geographical growth segment. As you can see on the bottom right-hand corner, the Southeast Asia portion is mainly driven by Vietnam, which experienced a 27% growth year-on-year. As for our outlook for Food Empire itself, we do think that coffee prices remaining high will compress margins in the short term. However, because Food Empire has many strong brands under its belt, so it provides them with a strong moat from new entrants. And because they diversified from Russia, as you can see from the bottom right-hand chart, Russia, because of the Russian-Ukraine war, the revenue from Russia actually took a hit. However, because Food Empire is able to diversify to different geographical segments, so this provide new sources of revenue, and they are able to grow their revenue because they have diversified. So this is a strong point for them as well. Yeah. So that's all from my end. I'll pass on the time to other colleagues. Thanks.
Thanks, Ivan. Good morning, everyone. I'll move on to the technicals. So first up, taking a look at S&P 500 last week. First 4 days of last week, the Monday to Thursday, we continue to see the extension of a pullback. Before on Friday, the index actually retested this main uptrend channel support in blue, which held as the key support since October 2023, and we had a bit of rebound from there. Overall, for the week itself, S&P was down 0.8%. For this week, I think we're likely to see some sort of a consolidation with some near-term resistance still remaining ahead with the around 5,975 to 6,050 area, and current support is likely to be at 5,770 to 5,880 area. Next slide. So next one, I'll be talking about the Philadelphia Semicon Index. So we see a breakdown in terms of the chart. So look, this is the weekly chart. In terms of resistance, is currently around 5,050. Support levels at 4,060 and 3,160. Last close currently is about 4,766. So first things first, the index actually we see a breakdown of this ascending triangle formation in blue. This blue triangle, there was a breakdown where price was actually trading in it since July 2024, and we had a breakdown at the end of February. And secondly, the price actually closed below the 50-day, the 50-period MA, which is highlighted in red. So the previous time actually closed below this was actually February 2022, a period where we saw the index had a 48% drawdown from the peak to the bottom. And this is actually the first time the price actually closed below this 50 MA since it recovered above it in January 2023. So we think this is significant. And then the third point is that with that, we do see a bullish to bearish trend reversal taking place. It could do a mean reversion to a retest of the 200 period MA support highlighted in purple, which acted as a good support back in 2020 and 2022. And when we look at MACD, it supports the bearish view as well with the weak momentum, and also MACD line is approaching below the zero line. So previously it has maintained above the zero line since January 2023, and this could be a first time in a period of about over 2 years that we could see the MACD line go below the zero line. So that indicates weakness as well. Next slide, please. Next one, this is the monthly chart. So monthly chart, there's also confluence. So first thing is that price actually closed below the 5 period MA, highlighted, which is the blue line, and the red line is the 10 MA. So we also see that at the 5 MA is actually crossed over below the 10 MA as well. So that's a sign of weakness. Last time this happened was back in April 2022, during the period of the drawdown as well. So there's some similarities over there in terms of the price going below the dynamic support levels. And secondly, when we look at MACD, there's also a bearish crossover that took place recently, the past 2 months. If we do see a mean reversion, it could retest the purple moving average, which is the 50 period MA, as well as the blue trend line support, which acted as a good support back in 2020 and 2022. Next slide. So with that, we have a technical sell for the iShares Semicon ETF XOXX, $208.52. I think profit levels at $176 and $143. Stop loss $233.44. Last close for it was $208.52 on Friday. So in terms of the chart, the what has happened is actually similar to what I explained just now on the weekly chart for the SOX index. Yeah, so for this trade, the timeline is a bit longer than the usual. So it's because I'm trying to take on a trend reversal. So I think this one for the trade timeline of the trade, it could last up to 52 weeks. Yeah. Next slide. So next one, we have our ETF money for February. We see we titled it pullback for most asset classes in March. So first up, going through what happened in February for the different asset classes, they were actually quite mixed. Top gainer was actually Hang Seng, which was up 13.7%, and the top loser was the ETF tracking Bitcoin, which tumbled 17.3%. The rest was mostly flat trade, which was moving between 1 to 2%. In terms of current trends, gold, Singapore equities, Hang Seng Index are currently in uptrend. S&P, US Treasury bonds, and oil are in a range consolidation. In terms of our outlook for March, we expect most of the asset classes to actually continue to pull back in March for gold, oil, Bitcoin, and Singapore equities, as well as Hang Seng Index. S&P 500 could see a bit of rebound from the current levels, and US Treasury bonds could extend its gains. Next slide. So I'll go through the ETFs one by one. First up is the S&P 500 ETF VOO. So in terms of the chart, we see that the price actually retested this main uptrend channel support highlighted in blue. So this has been holding price since the start of last year. So from this level, we do expect a bit of a rebound from this key support level, which is acted as a support back in April as well as August last year. So but however, some resistance is likely to still remain above 560. So we could still see a bit of a range consolidation taking place as the index has been just sideways since December of last year. Next slide. Then next one is the Treasury Bond ETF, IEF. So for this, in February, the price actually broke above the downwards resistance line highlighted in the blue line. Also it did a throwback of the breakout and then continued hold as a support. And in the last week of February, just continued to break above the swing high resistance that's around $94.80. I think so with that, with the bullish crossover and an MACD as well, we could see an extension of this current momentum upwards to actually retest closer to the next resistance area at $96 to $97.65 about that. Next slide. Next one is the Gold Mini Shares Trust ETF, GLDM. So for this, overall uptrend is trading in an uptrend channel since March of last year. Then it actually hit the channel resistance in February. That's around about $58, $59 about that. So I think we expect a bit of a pullback from the current levels, do a bit of a mean reversion towards possibly towards the channel support again. That's closer to about $54 about that, which is confluent with a previous ascending triangle breakout that happened in January this year. Next slide. Next one is the Oil and Gas Exploration Production ETF, XOP. So for this, there's still some weakness overall, with a series of low highs formed since November of last year. And we see that price actually just continue a bit of a sideways kind of trading to actually retest the 125 key support level, which has helped price since August of last year. So we do see a bit of a pullback back towards this key support level. Next slide. Next one is the Bitcoin Strategy ETF, BITO. So for this, there was a breakdown of the range consolidation it was in. That's around $21 to about $25 in the last week of February. So I think with that, with the fresh breakdown, we could possibly see some further downside ahead to possibly retest the previous resistance. That's about at 17 to about $18 area about there. Next slide. Next one is the Singapore Equities ETF. So for this, it's trading in the main uptrend channel highlighted in blue and continue to inch higher in February at the start of February before turning a bit sideways in the second half. As it's currently at the resistance area, we do expect a bit of a slight pullback. Just to perhaps retest the 380 previous resistance level, which will act as a good support level still. So I think maybe a bit of a range consolidation might take place for now. But overall, the uptrend still remains intact. Next slide. And next one is the Hang Seng ETF, so 2828. So for this, had a strong run in February since breaking out of a downwards resistance line as well as a horizontal resistance breakout. That's about at $78. Retested the uptrend channel resistance highlighted in blue. So I think after this strong, we expect a bit of a cool down pullback to retest some of the previous resistance levels at around $88 to $92. Around $78 to $82. Whereas short-term supports. Next slide. Now, so next one, we have our Thai SDR money for February. So we titled it most SDRs to extend their weakness in March. So just to give a heads up as well, I think if we look at the Thai index, the SET index, it's actually entered into a technical bear market as of last week, down over 20% from the peak from a swing high in October last year. So that kind of explains the weakness we are seeing with the Thai SDRs as well. So review of February's performance, you can see that all except one were in the red. So the only exception was CPO, which snapped a 4-month losing streak for 3.8% rebound. The rest, the top loser was Delta Electronics, which crashed 38%. Some of the other SDRs that posted huge losses were Airports of Thailand, which was down 21%, Gulf Energy down 13%, Siam Cement was down 17%. So in terms of current trends, most of them are currently in a downtrend with the exception of Kasikorn Bank and Advanced Info Service, which are in the range consolidation. In terms of outlook, we expect this weakness to actually continue for most of them, for CPO, PTT, Kasikorn Bank, Siam Cement, and Advanced Info Service. Delta Electronics, we could see a bit of a sideways consolidation after such a big decline in February. As for Airports of Thailand and Gulf Energy, we could see some slight rebound from the current levels. Next slide. So first up, for Airports of Thailand, you can see that in terms of the chart, there was a breakdown of the descending wedge support level where price just came down back all the way back to retest some of the levels seen back in 2017. So I think with that, we could with price holding around $41 for the past 2 weeks, we could possibly see some sort of a rebound. You can break above $44 to maybe hit like 47, 48 about there. So some slight rebound is possible. Next slide. Next one, for CPO, price had a bit of a rebound in February after holding the support level closer to about $49, $50. However, we expect some near-term resistance ahead, coming from the downwards resistance line, a retest of the downwards resistance line, as well as a retest of the bearish flag breakdown, and also the horizontal resistance. That's all taking place around closer to $58, $59 about there. So there's we expect some near-term resistance ahead that could see the price revert back down in the downtrend. Next slide. Next one, for PTT, the price chart is still quite weak. Overall trading in a descending broadening wedge highlighted in blue, and price was sideways around resistance before a breakdown in the last week of February. So I think with that, you could see extension of this bearish momentum to possibly retest the wedge support again, and as well as a horizontal resistance back in the past. In 2022, that's around closer to about $100 level about there. Next slide. For Gulf Energy, in terms of the chart, is continued a downtrend, continue to extend its downtrend in the downtrend channel. However, it did a retest. It's currently doing a retest of the previous downtrend resistance line breakout, the black line, as well as the downtrend channel support. So we could possibly see some sort of a bounce, some sort of a slight bounce from these levels, with resistance still remaining above 52 to 55 area, which was the recent breakdown area. Next slide. And for Kasikorn Bank, it was previously one of the more bullish SDRs, but price failed to actually maintain a breakout above $160 about there. And subsequently, we saw a breakdown of the ascending triangle formation support. So I think with that, we could maybe see the price revert more towards a range consolidation type of move to actually retest some support, horizontal support level closer to about 150s. Closer to about 150, mid 140s about there. So maybe see a bit of a slight pullback. Next slide. Then for Siam Cement, overall, still very weak. You can see in terms of chart, it's just trending downwards along the descending broadening wedge support. So and with a breakdown in the last week of February as well. So perhaps for this, I think we could maybe see price continue to move downwards to actually retest the next support area around 111 to 118, which was some levels made very long ago, around 2009 about there. Yeah, next slide. Then for Advanced Info Service, this one's still looking better as compared to the rest of the SDRs, just trading in the range consolidation. So it's just still kept in about 267 to about 300, that area over there. So it just continue a bit of range consolidation, pullback on resistance. So perhaps we could see maybe a bit of a slight downside, maybe to retest the range support again back around $260. Yeah, next slide. And last but not least, for Delta Electronics, this one, in February, price wasn't able to maintain the previous double top resistance at 118, and then there was a huge gap down after the results, with the price going back all the way closer to $70. So $70 was quite a strong support level in the whole of 2023. So I think with price coming back to this support level after a huge decline in February, we could possibly see price do a bit of a sideways consolidation in March. Next slide. Yeah, so then this is my last slide. So this is just an update on the current trades in progress for technical calls and also some of the trades that initiated in February. So some of the update is that for Franken sets, Nam Cheong Hang Seng Index ETF, ISO team and Co Brothers Equity, here our take profit levels. For Centurion, Yoma, Beng Kwang Marine, Tuan Sing, Pacific Radiance, and Capital Investment here stop loss. As for the current two trades in progress, they are Singtel, which is currently up 3.6%, and Lei Chun is currently down 3.6%. So that's all from me. I'll hand over time to Paul to talk about Yangzijiang Financial affiliate on the ground. Thanks.
Yeah. Okay. Thanks, Zane. You want to show the ETF monthly again? But I guess we'll do it later. Anyway, this is Myanmar is not around, so this is her meeting notes. So Yangzijiang Financial, as you know, they have two parts of the business: lending money. I wouldn't call it loan sharking, but they call it lending money in China, and also they're starting a private equity business in Singapore. So the outlook is still weak. Just that you saw the earnings jump up because there was a reversal of allowance. The outlook is weak generally for two things. Because the NPL in China is still rising. I think the management is not really optimistic of the economic conditions in China. The stimulus didn't really help. And I think what is happening in China is that the property prices continue to collapse. So that's why as a lender, your collateral value will drop, and that's why your NPL continues to rise. And the second key thing to note, the yield is attractive, but I think like we mentioned before, I think the Chinese banks are probably giving similar, if not higher, dividend yields. And the second thing is the earnings will continue to drop because they're pulling out money from China and then putting out into private equity investments in Singapore. They're building a franchise here, but I don't see the franchise yet. But most of the franchise is to build third-party money, but I don't see any third-party money. It's only their own money. But anyway, we just think that as they transition out of China, move into Singapore, you take at least 2 to 3 years before the earnings recover. So that's why for us, at least the outlook isn't great. Although you see this big pop up in earnings, but actually it's mainly because of just a one-off provision. Next slide. I'll move on to Yangzijiang Shipbuilding. So Yangzijiang Shipbuilding, for the year, the earnings is up 60%. So they continue to do well. But some of I guess the call, I wasn't there, but I think based on what Myanmar's been mentioning is that in general it's been a bit negative because they had 2 LNG vessels that was cancelled. And they are worried that they are not able to sell the LNG. So that's the first negative. The second negative is that, as we all saw in the news, the US trade representative is going to propose a 1.5 million for every vessel that docks in the US. On paper, it looks like they can pass on, but I mean, if this is like a few times a year, I mean, all this will start to add up. They still they say that they have not seen any impact yet on the demand, but this is obviously another second negative. The third negative is that any deliveries that they have, the problem is also the yard is very full. So any inquiry is also deliveries is going to be in 2028. So they also can't grow the order book much anymore because the delivery is a bit long. And the fourth one is that they are also starting to lose a bit of competition or deliveries to the Korean shipyards. So that is another thing that is happening. So the outlook just that has multiple negative news. Although they did raise the dividend and the yield now is the 66.5%. But I don't think anybody buys Yangzijiang Shipbuilding for the dividend yield. So that's why the outlook is a bit more negative for Yangzijiang Shipbuilding. Let's move on to the next slide. Yeah, she also mentioned Delfi. So for Delfi, the earnings wasn't great, but they just mentioned that the cocoa price will continue to be stable, and there is continues to be a very intense competition. Yeah, so I think this one also the outlook is not so great. Yeah, let's move on. Okay, move on to ComfortDelGro's fourth quarter results. So for us, the ComfortDelGro, the UK is the one that's really the shining light, because that's the one where it's performing the best for ComfortDelGro. Next slide. So we move on to the results. So the results actually beat our expectations at 112% of our full year. It was all about the UK that did really well. So UK earnings, if you exclude the acquisitions, they made two big acquisitions. The UK earnings actually still jump up almost 200%. So why is UK doing so well? Okay, it's not that because people are taking more bus rides, but it's mainly because their margins is climbing. So they've been renewing their contracts from 2% margin to, I think, mid-teens now to, or even high teens, because of competition exiting. As they continue to roll like 20% of their bus routes, because it's a 5-year contract, then the margins get a big jump, because a lot of players exited because it was a bit of a really irrational competition a few years ago. So that's why you get this big jump, and this should continue the next 2 to 3 years. The negative is Australia and China. So in Australia, they have is the bus rides, and for Australia, if you look on the left, although it was up, if you exclude the acquisition, it was down almost 30-40%. Mainly because in Australia they couldn't find enough bus drivers. So when you're doing this business, of course it's a good business, it's a cost plus recurrent. But once you can't find the bus drivers, if your bus is late, if your bus doesn't go on schedule, you get penalized. So that's what's happening for them in Australia. China is also weak. China is actually almost like a no-brainer business, because every ride-hailing company need a taxi license, so you give out the taxi license to them and you just like rent out the car. The problem in China is that economic conditions is so bad that a lot of those drivers are not returning. They don't want to drive taxi anymore or ride-hailing, and they rather do other jobs because the economic conditions just so tough. So that's why in China is also weak. If we move on to the outlook for us is still positive. We raised our profit earnings by 9%. We also moved up our target price. So in terms of the outlook, the UK will continue to do well. So UK, they are gaining share. They are taking more bus routes, especially the recently announced Manchester bus routes, and the margins are creeping up because of this whole repricing, and they will get the contribution from some of the acquisitions they make. So UK will continue to grow strongly. Singapore is slightly problematic because Singapore earnings might drop a little bit, because what they do see is a bit of an unknown, because in Singapore they recently released 2 new ride-hailing apps. But one is Transcap, another one is just slip my mind. I think it's called Go AI, or they're supposed to be using blockchain or AI to help on ride-hailing. I really no idea how that works. I mean, you still need a car, but they just worry that the 2 new ride-hailing apps might actually cause some competition. They haven't seen it, but they're just a bit worried. So the guidance for that is a bit softer. They also lost the Jurong West bus package, so that will also be another weakness for them. But Rail should recover. So Rail has been weak because they lost, the authorities, they give something and they take back. So they took back some of the advertisement concessions. So Singapore would be at best flat. Australia should start to improve because they said that the bus shortage is gradually improving. So the final point for Comfort is that they are continue to raise the dividend. So they are paying almost 80% of all their profits as dividends. So which is really high. I mean, you're actually paying all your profits as dividends. So the dividend yield now is probably almost 6%, and if based on our forecast, you could look at maybe 6.5, 6.7% dividend yield for them, because they are usually, this is the second year they continue to pay 80% payout ratio, which is high for any company. I mean, to pay 80%. Next slide. Move on to Sheng Siong, rising market share. That was the main highlight for us. So after so many years of covering, I think this is the first time I think we saw Sheng Siong disappoint a bit in terms of the results at 97%. So let me just go to the positives. So for positive is the new stores. So in Singapore, grocery shopping isn't a high growth industry. I mean, probably like 1 to 2% growth. So you need new stores to fuel growth. So for them, they grew their footprint. That means the square feet of, if you look on the slide here on the left, it's about 661,000 square feet by 7%. So this is meaningful because this is double the average expansion they did. They were growing roughly around 3% per year in the last 3 years. So this is doubling the pace of expansion. So at least for us, then we will know in the next 1 to 2 years, at least in the background, there's at least 6 to 7 percentage points of growth coming for this in terms of revenue contribution, that there will be additional growth drivers. So that's why new stores are important. The negative is really rising staff costs. So staff costs used to be 13% of revenue. Now it climbed to 16%. So in a way, whatever gains they had in gross margins was actually eaten up by the staff costs. So why staff cost is rising is mainly because of progressive wage model. If you recall, the authorities introduced progressive wage model, which is basically another way of saying minimum wages, although you call it progressive wage. But in general, just think of it as minimum wage for all the retail has been increased. You're talking about cashiers, you're talking about butchers, you're talking about those who load products on the shelf. So that if you look at those numbers, it's around 8%. But it's not just the cashier, but once you raise the salary of the cashier, then almost everyone in the store would need to be increased, because you always need to keep a difference. The manager will be asking, the cashier wages went up. What about mine? And of course, another challenge is also the foreign dependency ratio, but I won't go through that. So basically, as a result of that, we actually lowered our earnings because the rise in staff cost is actually more severe than we thought. Of course, we also did increase our target price. Of course, you'll be wondering why. Because what we do is that once we move our target price to 2025 earnings, which is higher than 24, so by default, our target price will increase unless we cut the PE ratio, which we didn't. We kept it stable. But the main point here is that although this staff cost actually impacts them, but actually impacts everyone. So that's why we do see competitors are exiting. So over the last 2 years, we saw Sheng Siong's revenue grow 4 to 5 percentage points faster than the industry. We don't have their market share, they never give, but at least we know they are outpacing them by at least 4 to 5%. So they are definitely growing market share. And they're all taking stores from other competitors, especially Giant. So Giant has like 40 stores. I'm not sure they're not clear how many are in HDB, but Giant has, out of the 5 stores that they secured recently, 2 are from Giant. So Giant is really giving up stores. So the good news is that this staff cost although it's hurting, but it's hurting the competitors more because they don't have high gross margins. And so the story for Sheng Siong is they're just grabbing market share. Next slide. Move on to Raffles Medical, returning to stable growth. So for Raffles Medical, my forecast my forecast can never be accurate. It's always out. It's either too high or too low. But anyway, this time around is 127% higher than my forecast. So what happened was that the healthcare services did really well. If you look here at the bottom here, 137%. Sorry, it's not highlighted here, but the positive is that insurance turned around. So the insurance turned around because they have been a bit tighter on processing claims. Healthcare, they said, recovered because there are more elective surgeries returning, and foreign medical tourism is also improving modestly. It's not like back to pre-pandemic, but there is some modest improvement. Excuse me. So I think this has actually helped them. We raised our earnings by a huge 38%. As I mentioned, we can never get their earnings right. But our target price, we moved from the 96%, and we raised our recommendation from neutral. Although we were neutral, but our target was actually 96. It's actually higher than the last price. But we raised it to accumulate. The company is also turning aggressive in returning capital to shareholders. They are raising the payout to at least 50%. I mean, it's don't sound much, but the key one is that they are actually planning 100 million of share buyback the next 2 years. I mean, never seen Raffles been so aggressive. So one of the reasons is because the last 3 or even 4 years, they've been spending a lot on their China hospital, but that has stabilized the Shanghai, Chongqing ones. And because of that, they can return more, and they got like, I think, 300 million of net cash. So they are returning capital back to shareholders. And just as not in the slides, but actually China is also starting to improve. But it takes time because China is only 10% of the group revenue, but it is and they think it could actually break even faster than expected by next year. Next slide. So I'll move on to PropNex. I got a lot of results to talk about. PropNex, so 25th anniversary next year, so we think it's going to be a bumper year for them. Next slide. So for PropNex, the results was also below. Although we did see property market recover very strongly in the fourth quarter, especially in November. I think fourth quarter property sales was up year on year, almost like 200% up. But although you sell something in November, the revenue for a real estate agent will only come in January onwards. Because in November you give the booking check, I think it's 5%, but you still need to gather that 25% of deposit to the developer. You still have to get bank loans. You still have to sign the sale and purchase agreement. So all this takes roughly 3 months. So that's why you will only see this big, huge jump in their earnings from new launches in first half of 25. The positive, actually, there wasn't really much positive to say, but the positive was really it's still a really strong business model they have. It's very asset light. Free cash flow, the ROE is 33%. Half the book is cash. If you take that out, it's almost 60-70% ROE. They only spend, I think, 500,000 on capital expenditure. But having said that, it's because of the nature of the model. The barrier to entry, the capital needed in this business is not fixed assets. I mean, it's really the real estate, the number of agents you have, and the intense activity that you do, the promotion activity. So that's why sometimes using fixed assets, equity is really not a good barometer of the returns on capital, because they rely on agents and not on how many shop houses you have, on how many computers you have. In terms of the negatives, it was I think the project marketing on new home sales, if you look on the left, that dropped about 27%. But I think, like we mentioned, this will pick up in the first half in terms of the revenue. We raised our earnings by 9%. So the big driver for 2025 is going to be new home sales. So they are looking at, if you do the midpoint forecast, you're talking about at least a 30% jump in the amount of homes sold in 2025. Now, then you add in improvement in prices, you're talking about easily, at least 30% plus growth in the new home sales. Assuming the market share remains the same, because you're going to get also higher prices. And the good thing about paying commission is that if the price of the home rise, your commission amount also rise, because it's usually about 3%. We raised our target price. We turned our WACC. I think our WACC is a bit more too high, about 12%, right, for something that's cash, net cash, and also because we always thought was a very volatile industry, but right now we notice that the volatility isn't as bad, even though unit sales are down. Just the final point here is that they are still a really dominant company. They have like 64% market share according to their own computations of unit transacted. So every 3 transactions in terms of HDB resale, new home sales, private property resale, secondary market, 2/3 of it is by their right now it's about 13,000 agents. So they are really dominant in this industry. Next slide. Okay, we did this slide because I think everyone here is, I guess, kind of a property owner. If you just want to understand what is their guidance, I mean, they are the leaders, so their guidance is pretty accurate. They are guiding at least 24-39% pickup in volumes. In terms of resale, you can see here all the numbers just for info. But just on the new launch, they expect more launches because last year only 7,000 new launch. This year is almost double that, about 12,000. But why they think demand is strong is because some of the projects that they did, the demand is almost 3 to 4 times. There was a recent project, I just slipped my mind, the park something, which there were 1,200 units launched, they collected almost 3,000 to 4,000 checks. So that's why the new launch you have to get balloted, and actually whoever got the unit, they actually celebrated. I mean, don't ask me why, but this is how it works. But when you have 3,000 to 4,000 checks or bookings more than the actual launch of 1,000, it just shows that the momentum is very strong. There's I wouldn't say a frenzy, but it's actually very hot market right now. So that's why they think the demand for new home sales is going to be strong in 2025. Private resale, I won't go through everything yeah, unless you have questions, but they're just saying that it's cheap, but people still prefer to buy new home sales. HDB, you still get good demand because of rising population, right sizing by the older generation to HDB and so forth. Yeah, it's all in the report, if you want to read. Yeah, next slide. Okay, next one is ST Engineering. So they are firing on and flying on all cylinders. It's just a pun that because firing is defense and flying is they're another big part of the business is actually aircraft maintenance. Yeah, next slide. So for ST Engineering, the results was generally within our expectations, but no second half, the earnings really jumped strongly to 32%. Most of the growth came from commercial aerospace. So commercial aerospace, just to give a background for those who may not know, is aircraft maintenance. When all aircraft thankfully need to be maintenance on a certain schedule. So they maintain the aircraft frame. They also maintain the aircraft engine. So they benefit because these days, air traffic is still rising, and secondly, because of a bit of a delay in aircraft deliveries, airlines are using more and more of the aircraft, so that benefits in the maintenance work, because the wear and tear on the aircraft is higher. So that did well, the margin surge. There's a bit of lumpiness too, some spare parts sales, I won't go through that, but general is still positive. The negative is actually Satcom. So Satcom is their satellite business that they had. So what they do in Satcom is basically they help customers. They don't own the satellite, of course. They're not a telco also, but they help provide equipment to connect to maybe a EMASat satellite and so forth. But the problem they have is Satlink, which is of course as Tesla SpaceX. So customers are changing. Their customers like EMASat is losing a bit customers. So they are now coming up with the equipment that can tap on Starlink, can tap on all the orbits, the EMASat, the GEO satellites, the LEO satellites, and the higher orbit satellites. So that's why it's still down. I mean, but it's a smaller part of the business. But anyway, let me just go down to the key points. We are raising our earnings. We nudged our target price to 610 because our growth forecast was a bit soft. I mean, our discounted cash flow forecast was only 1%, but you've seen the way they grow, so we nudged it up to 2%. So we think it will still be another strong year for them. So commercial aerospace will benefit, like I mentioned, as planes travel. And the next thing that will be another boost is the engine parts. So they actually do the LEAP engine, which is for the A3neo, mainly for low-cost carriers, the single-aisle plane. And I think Airbus has mentioned they are ramping up deliveries, so this will benefit them. So in the A320, the engine, the casing, they actually manufacture the casing for the A320. So that's why when Airbus produce more A320, they will benefit. And of course, defense spending, we don't have to talk. I think we saw the conversation, I wouldn't call argument, but at least the conversation between Trump and Zelensky. So what this means is that no nations, especially in Europe, have to rely on their own defense spending budget and cannot just rely on the US. Even in Singapore alone, if you saw from the recent budget, Singapore is raising their defense spending by 12%. This is 50% a growth rate that's faster than 8% that Singapore experienced. So this is, of course, the de facto benefit provider of all the defense is actually going to be ST Engineering. Next slide. Okay, let me just move on to some key highlights. Nothing much from Singapore. Just one thing good is that the bank loans, Glenn will provide more details when he comes up with the monthly, but bank loans is a good start to the year. Although you will notice December not much change, but you just remember, but January last year, the loans was actually still contracting. So loans now is actually growing 5% compared to a year ago was actually down 2%. So there is a big turnaround in loans growth, and this will help the banks even though net interest margins might contract a little bit. Exports is so far, one thing negative is the exports. This is not Singapore, sorry, actually it's supposed to be Korea, sorry. The good news in the US is at least inflation is still coming down. But I think the market is just a bit not celebrating yet because they're worried about all the tariff concerns. But it's actually very positive that the inflation is actually coming down. Yeah. Probably 2.65 is I think it's like a 3-month low year on year. Next slide. But so in terms of tactical views, I think like we mentioned, if we exit Pax America now, which means that if we exit a world where US is not the one providing all the defense spending or defense or protection to all the countries, then it's going to be positive for defense spending, which I think even ST Engineering kind of agreed to that there's a lot of demand for defense so now because a lot of countries now realize that they have to be more independent on their defense spending and I guess can't just outsource it to the US. Like we mentioned, real estate continues to be very vibrant. In terms of China, we actually did meet two companies that have property development work in China. But the China real estate is still very weak. I think in general, maybe tier 1 cities is still improving. Like Yanlot actually wrote off 600 million together with last year 2023. So Yanlot wrote off almost 1 billion of development properties. So all these development projects that they have, they just wrote off 1 billion over the past 2 years. They mentioned that although the government stimulus it was helpful, in terms of at least the government realized there's a problem, but they're not sure if the recovery in property demand can be sustained. And for Yanlot, the key thing is that the problem they have is that they have very high inventory and they have inventory they have 4 years of inventory. So what it means that if they sell at the current level, it takes them 4 years just to clear the current inventory. So they are more concerned of clearing inventory than try and buy new land bank or that. Another developer we met, their sell-through rate, in Singapore, some of the launch you sell 83%. For China, some of them still have only 1 to 2% sell-through rate. That means out of 1,000, they only sold like 1 unit or 2 units. So some of them are really suffering. So because their households are still, the perception has changed. Property no longer seen as obviously a safe haven. And unless you cut prices by 50%, you don't expect your property to move. Yeah. That was some of the comments we got. Other news, corporate news, because the whole week has been full of corporate news, has been Oiltek. So Oiltek announced a heads of agreement with, this is the all major Pertamina. So Oiltek such a small company, so for them to do a deal with Pertamina is a big deal. It's still heads of agreement, which means that they agreed to make this to build this plant, but just that the final terms not has been confirmed. But this Pertamina deal that Oiltek is doing is positive because they're going to do a project. They're going to get revenue from building the plant, which is a feedstock plant to a SAF, that means Sustainable Aviation Fuel Oil. And then they will probably take a stake in this feedstock plant, and then from there they can get recurrent income. I think the share price moved today also because they announced some bonus issue. But one good thing about all the results so far has been corporates have been aggressively returning capital. So if you look at Comfort and Venture, Comfort's payout ratio is 80%, Venture is 90% payout ratio. So corporates are turning, excluding the banks. The banks we all know very clear they're returning capital, but even corporates now more and more are returning capital to shareholders. Raffles, I don't think they ever bought so many shares, 100 million. Q&M is also announcing 50 million share buyback plan. So it's a good thing, good for the whole market that they are returning capital and not just hoarding everything. Some of the key events we saw Misu. I think Misu's IPO price up almost 40%. But then the key one to watch is the US payrolls coming on 7 March. See, these are some of the corporate events. Feel free if you're interested to know more about what's happening in the property market, you can just dial up to Epic Realty, which is essentially ERA. Next slide. This is just a slide that Singapore economy, so far the indicators are healthy. Bank loans are up, production activity is up. Next slide. Yeah, didn't have time to do so much on that. Just one last one on AEM. Listening to their call, the reason why the share price was weak was because of the guidance. But anyway, let me just go through. for those who do not know, AEM is a semiconductor test equipment and consumers provider, and they also have a contract manufacturing business. I think that one is just to boost up the revenue, but they actually did turn around. The fourth quarter earnings did turn around. If you look at it from a loss, look at the bottom part, from a loss of 4.3 million to 13 million profit. But I think what that hurt is the guidance. So the guidance, 155, 170 million is actually either a 2% or a 11% drop year on year in revenue. And the other thing that worried the market is that they said there's no visibility for the second half. Yeah. But what actually for us, we are much more positive on AEM. Not so much in the near term, but just in the medium term, because there are new customers. They never mentioned, but our guess is AMD and Micron. They never officially mentioned, but we only think, this is our own guess. Because it's HBM memory and AI. I don't think it's NVIDIA, otherwise the numbers won't be so low. So I think one thing is that they're riding on a major trend, because AI chips, the power in the AI chips continue to climb from currently 1 kilowatt to 2 and then 30 kilowatt eventually. And the package size is also, because in a single package, the black thing that you see, semiconductor package, they are adding more and more chips. So it's getting bigger and bigger because they're stuffing everything inside the package. So because of that, you need more and more testing, more and more sophisticated testing. So that's why which is a very commendable thing they did, because to try and penetrate semiconductor equipment, nobody knows you apart from Intel, but you managed to get 2 big customers. So it's a very positive thing. If you assume 350 million revenue this year, you're still talking about 25 times PE, but I think the problem is just the whole Intel thing. I think nobody really knows if Intel, I think the market is just not sure that because Intel's orders is actually shrinking. So because of overcapacity and and they are not coming up with new developments. So my view on the stock is that there's probably better opportunity at lower levels. And also the other unknown is that if Intel is taken over by TSMC, what's going to happen to AEM? Usually the supply chain should stay stable, but I think these are just the unknowns. Although in the background, I think AM is performing really well to get such huge customers, because it's a really an unknown brand in the market. Okay, with that, I think I move.
Hey, thanks, Paul. Yeah. I'll take on some of the questions first. I think there's 3 of the questions regarding the banks. Excuse me. Yeah, it's really all quite similar. So it's really just excuse me. It's really just asking what is the best pick. I forgot to mention it earlier. Give me a minute. I need to sneeze. Okay. So just basically asking, what's the outlook? I did go on it talk about it a bit earlier. So but I'll just maybe mention it more in detail. And also, I think more importantly, what is the outlook on the Singapore banks in general. Yeah. So for the Singapore banks in general, it will really be it's really just all about the dividends and the capital returns that they're doing, and also the continued fee income growth which we have seen in the 2024. But in 2025, I think even more so, this will be more important, because the net interest income has started to decline, and net interest margins have also started to decline, which is within our expectations. But fee income will be the main differentiator in how well they do in terms of their earnings. But then again, there's also this worry, or it's not really a negative, but it's a worry that allowances and especially specific provisions will come in quite high, as we're going back to more normalized levels, and then we will tend to see maybe a bit more NPLs and specific provisions that get put there. So, but there's also a worry. But then again, it just to nonetheless, that the banks have this huge management overlay that they have accumulated over the past few years, mainly due to their experiences with what happened in COVID. So they did accumulate huge sum where they can protect themselves. So DBS is the only one that mentioned how much they have, around 2 billion. So what they do is that if the specific provisions come in too high above what they are targeting, right, they can write back some of this management overlay that they have into general provisions. So there will be general provisions, GP writebacks, and then this will offset the higher specific provisions. So net, we're looking at quite a stable credit cost, and in total, there are allowances as well as provisions for the banks. So if you're looking at all of this, I think there's one way that the banks will be able to maintain their growth is to really control their expenses, because the banks have been growing, in terms of their tech side. They're putting in a lot of money to try to. I guess one of the reasons is also to compete with the digital banks, right? They are coming in, and to, of course, maintain their current customer existing base, and also to grow into the new workforce and the younger generation that is coming in, right? Which are more, I would say, more tech savvy, and they're looking to get a bank that is more suited to their needs. So that's why the banks are putting so much money in the tech sector, in the tech side, sorry, for them to upgrade their apps and their platform. Yeah, so I think that's how they're going to be able to control their expenses moving forward into the year. Yeah, I think our favorite bank would be our topic for the banks would be UOB. If you look at the other two banks, DBS and OCBC, their earnings growth is quite flat, right? For DBS, and it's for different reasons. DBS is mainly due to that global minimum tax. So the reason why DBS is hit so badly is because they do get a lot of tax incentives. They have a larger they get larger proportion of their income from trading. Hence, that's why they get a lot of these tax incentives and benefits. So this will have hit them by around 400 million, right? They are only, I think currently their average tax is around 12%, right? So if you bump it up to 15%, it will hit them by 400 million. So this will really dampen their earnings growth in 2025. So we're looking at flat for the bottom line. For OCBC, they can't really, there's no driver, like a very big driver for OCBC. They don't have any acquisitions or these big acquisitions where they can, put a lot of their effort into to try to grow inorganically, right? They only just did that one, the PT Bank Commonwealth in Indonesia, but it's so small. They are also trying to grow there, right? They're trying to grow organically by increasing their RMs, trying to be more aggressive in sales, especially in wealth management fee income. But it's not really as big of an accelerator as compared to acquiring like the Citibank assets, which the other two banks have. So that's why we believe that their earnings growth will be quite flat for OCBC. Whereas for UOB, we are estimating it to grow by around 12% in FY25. And this will really come from the substantial fee income growth, as we believe, that they have successfully integrated all of the 4 Citibank assets in ASEAN. So they can finally concentrate on growing instead of trying to, what they were doing in 2024 was really just ensuring that everything was transferred over properly. They follow all the compliance guidelines. So now they can finally concentrate on growing. And also their trading income will continue to grow. And last but not least, we believe that the loans growth recovery will be the most beneficial for UOB, because they are still at the core a commercial bank, right? So this loans growth will be able to benefit them the most. And if you want to compare dividend yield as well, UOB is also on par with DBS now that they have also released their own version of capital returns, right? We estimate it around 6.5% dividend yield for UOB in FY25. For DBS, it's also around 6.5%, and then OCBC is around 6.1%. Yeah, so that's all the reasons why we believe that UOB is our top pick. Someone asked about the GE, right? Yeah. Yeah, so for GE, they are still accumulating, but they have not yet. So the interesting news about GE is if the shareholder had previously accepted the VGO, right? Previously, that means they've officially already sold off their shares to OCBC at that price, right? So they won't, if they do come out with a new VGO, right, the new offer, they won't be the previous people that accepted, the shareholders that accepted at that price won't be able to get the new price, right? It's only for the the left of those sorry the existing shareholders, the minority shareholders of GE, right? It's still hovering around 93%. So they are still trying to accumulate more and more shares, but there's no news on whether or not they will be able to fully acquire it yet. I think they haven't met their deadline yet on whether or not they need to. I think they got an extension, so I think it's a few more months. So they haven't been pushed yet, I guess, by SGX to see if they need to delist it or they need to put back the free float so that they can continue being a listed company. Yeah. I'll get more details on this, but there's really not much that there is out there because it's been postponed, I would say. Yeah. So I think really just have to wait and see if they do come out with a new offer. But their guidance on this is quite clear that they do want to fully take on GE because they believe that is their way that they can continue to grow. What they're saying now is that GE is pivotal to them growing in the insurance area because from what I know is that they a lot of their OCBC customers have GE, but GE customers don't have OCBC accounts. Sorry, no, the other way around. GE customers have OCBC accounts, but OCBC customers don't have like a GE insurance product. So when they fully acquire, they're able to cross-sell it more efficiently and more effectively. Hence, they call that the synergy, and that's their way to grow moving forward. So I guess it hasn't fully come to fruition yet. So we just need to see how will that work out. I think that's all for the banks. Maybe I'll hand it back to the rest of my colleagues first. Yeah, thank you.
Hi. Can take on some questions. I think there's some questions on WeHer. Yep. Ben, any comment on WeHer swing into loss? And another question is also similar. What is Philip's view and outlook on WeHer now that they... Sorry, the questions skip. Now that they have reported a loss and no sign of special dividend. Yeah, so I'll answer regarding the first part first. Yeah, so based on second half results, yeah, WeHer reported a loss. So when I look at the statements itself, the loss is mainly because of fair value gain on properties because for the second half itself, they actually recorded a fair value loss on investment properties. So if you look at the full year results itself, based on the PATMI itself, if you strip out the fair value gain on investment properties, if we look at the adjusted PATMI itself, is actually they posted a full year gain in terms of adjusted PATMI for FY24 compared to FY23. Yeah, so I don't think that's a cause for concern right now. But of course I will during this time I'll still try to speak to management, but I haven't had a chance to. So if I have the chance to speak to management, I'll update you all again. Regarding the special dividends wise, I also don't think it's a big cause for concern right now because in their latest announcements, they actually declared that they wanted to propose a final dividend of 0.08 cents. Sorry, 0.08 cents compared to last year's 0.4 cents. So if you look at the full year dividends for FY24, it's a total of 1 cent, I think. Yeah, total of 1 cent compared to last year's 0.6 cents. Yeah, so the fact that WeHer increased their dividends payouts is a positive sign. And for the special dividends wise, I do think that they will need some time because during the latest EGM in 28 February itself, they only just agreed to sell off the PBSA property. So I think over the course of this year itself, we will still need time for the net proceeds to come in and so on and so forth. But of course, the special dividend is not a guarantee. It's just our belief that it will happen. Yeah, so we shouldn't take it that it's a guarantee. But the transaction itself, it will definitely take some time. Yeah. So hope that answers the questions on we her. Um, Ben, for Pan United, please comment on its liquidity. I think there's another question about why is BRC Asia's liquidity so low? Yeah, so I for these two questions, I think my personal take is that because Pan United and BRC Asia, they are not listed on the STI index itself, they are still considered small mid cap. So in terms of its liquidity and trading volume is still not high. But I think from last week's morning call itself, we do believe that the SGX injection of liquidity will greatly benefit small mid cap companies. So I think that's a positive thing to look out for. Yeah.
Sorry to interrupt you. Maybe you can share how much special dividend are you expecting for WeHer? I mean, just to let everybody know, just in case the amount at least.
Okay. Special dividends wise, I personally think it will be like around 20% of 20% of the profits itself. So the profits, if we look at the profits itself, is around 30 million net gain. So I think it may be around 6 cents. Yeah, the special dividends wise. But that is just my belief. Yeah. It's not a guarantee and management didn't guide anything. Yeah. I think I see some questions on the. Oh yeah. Hi Iban, what's the positive and negatives for Nvidia and your outlook, please? Yep. So for Nvidia itself, one of the positive is that they have resolved their Blackwell supply issues because previously we heard that they were facing some issues in the packaging for Blackwell itself. However, they have successfully ramped up supply of Blackwell in the latest quarter. Yeah, so that is one positive. Second positive we see is that capex from big tech companies, they are still guiding up capex. So we do see demand still outstrip supply by a lot for AI GPUs. So that is a positive sign for Nvidia. For negative itself, we do see short-term headwinds because of the tariff announcements. Because Trump recently announced the 10% import tariffs on China goods. Yeah, so I think with the flow of tariff announcement and maybe some potential retaliation from China, Nvidia stock may be impacted as well because from the US-China trade war in 2018, Nvidia stock actually plunged more than 50% within half a year. So, however, we do think that this time round the impact will be less severe because Nvidia has much lesser exposure to China. Right now, they have around 13% exposure to China compared to 24% in 2018. Yeah. And another negative we see is margins compression. I think this is another question for me also. There's one more question on margins for Nvidia. Yeah. So for margins wise, we do think that margins will be compressed during the first 3 quarters for this year because as they ramp up production for Blackwell itself, there's greater costs involved in producing the Blackwell. However, management did guide that margins will recover towards the end of the year. And we also think that that will happen because as Blackwell fully ramps up, we do think that gross margins will recover back to normalized levels, which is around 75. Yeah. 75%. Yeah. Yeah. So I mean, back to your question on our outlook ahead, is that I think short term maybe for the first half of this year, there will be short-term headwinds from the tariff announcements and also margins compression. However, we are very positive for Nvidia because they are starting to ramp their Blackwell and also demand still far outstrips the supply of the AI GPU chips. Yeah. hope. Let me see if there's any more questions.
You might talk about the UMS thing.
UMS. Sorry, I didn't. Yeah. Oh yeah. I see one question for me also. What's the ratio of Blackwell to Hopper chip sales now? Yeah. The explicit breakdown wasn't disclosed by Nvidia, but Blackwell they currently sell around 11 billion. So it's a very positive sign because last quarter it was 0, but then this quarter it was 11 billion. So if we take 11 billion out of the data centers, 36 billion, that will be around 30%. 30% of Blackwell chips compared to Hopper. Hopper, I believe it will be close to 60%. There's also a very small segment of Ampere chips, which is the predecessor to Hopper, but that's only a very small amount. Yeah, so that's just my estimate. Oh, any comments on UMS FY results released last Friday? Yeah. Just now we just had an analyst briefing. I think overall for UMS I think it's quite positive because management did guide that this year itself we will have around like a double-digit growth this year. However, we don't think that the growth will be super like the Nvidia kind of growth. It's just like a low double-digit kind of growth this year. Yeah, because I think the key driver will come from their main clients, which is we suspect their main clients are equipment providers. So for example, like your what's that? Sorry, the LUM Research or your Applied Materials. Yeah. So but they didn't explicitly say that. We just think that it could be one of those. Yeah. So their market share is around 50%, and we do think that because when we look at equipment providers revenue itself, the revenue is on an uptrend right now. Yeah. So we are also quite positive for the future outlook for UMS itself. Yeah. I think that's all for me. Yeah. Can hand over the time to my other colleagues. Thanks.
Yeah, thanks, Iman. I will do the flip-on-ground next week on the rest of the semiconductor stocks like Franken, GVT. Just I didn't have time. I just everybody released results on the same day. But what is your valuation and call for CDL? So CDL, they value themselves at $20 RNAV. Our valuation is I think 690, 680. That's our valuation for CDL. UL, so sorry, we don't really cover UL, so I don't have a number for you right now. Can you help comment on Samudra post results? How were the shipping? Okay, I didn't attend, but this was what Miamel said. So the Red Sea improving is actually going to be negative. I mean, it's good for all of us. I mean, there's geopolitics coming down, but the Red Sea, as you all know, the Red Sea, because there were attacks along the Red Sea, so a lot of ships had to divert through Africa, the Cape. But what happened now is that with the Red Sea tensions getting toning down, more and more container ship owners are sending their vessels there. So once you send there, you don't need to go one huge and waste 2-3 days. So this will pull back capacity. But I think this is going to be negative for container rates, but it will be gradual. But what Samudra said is that this won't impact them so much because they are more intra-Asia. So it might be worse for the large container vessels, those with 10,000, 20,000 TEUs, those that go through, because Samudra is more Asia. They just move around Indonesia, move around Asia. They don't go through like from Europe to Asia or US to Asia. So, in terms of the Ukraine reconstruction, even if there is some benefit, which I'm not sure, even if there's no peace deal yet, but even if that happens, it won't benefit Samudra because Samudra is more intra-Asia. Yeah. Keppel DC rate appears to be on a downward trend. Please, yeah, I think Darren and Myanmar not around. But I think what is spooking the market is also the whole data center market. I think because Microsoft pulled back some, But I think Microsoft put back is because these were leases that they were going to exit anyway. So the market just takes the view that uh that even if Microsoft are pulling out of data centers, so I think that is actually hurting the market. But I also sorry because they're both not around, so I all the REIT questions I can't really answer well for you. Sorry. OUE okay. Let me move on to the next. GLW. Sorry, I'm not very sure what GLW is. Any upside on ceasing? There's not much movement on this stock. Yeah. So for ceasing, the growth is still going to be there. We still think the next 2 to 3 years growth is intact, mainly because of the fresh food production, the jump in fresh food. But we also know that promoting a China stock is not easy, especially if it's a sweet potato, right? I mean, like who in the world wants to go and buy a sweet potato, especially in China? But we still like it because we think the growth is strong and it's a food security. The tailwind behind them is the whole food security situation. So in the near term, it's going to be fresh and then processed, and the longer term is going to turn sweet potato into feedstock to feed hogs, to feed chicken, and so forth. So that's why we are still positive on this stock. Yangzijiang Shipbuilding has last few days. Yeah, I think the sell down was justified in the sense that the whole Trump phenomena imposing tax, and also from the call, I think like what Miao mentioned, there's also a bit of negative news. There's competition creeping up, and they also hit max capacity. So even if you got orders, what it means is that the revenue may have already peaked. Because any orders now they're getting is not going to be meant for this year. It's going to be meant for 2028 onwards. So the worry is capacity peaks, and they are also having 2 LNG ships, which the customer gave back, and the prices of these ships is dropping. So I'm not sure they're going to do any write down, but I think it's going to be so a lot of the negatives are coming back into this stock. And if the whole Red Sea situation is improving, then container rates come down, then you also worry if that container ordering cycle can continue. So that's all the because the whole container ordering cycle that benefited that means the shipping container cycle that benefited Yangzijiang was extended because of the war in Gaza, because of the whole Red Sea situation. The supply of ships suddenly shrank because everybody got to use the Cape. And then because of that, the container rate spiked up. So it was extended, but I don't think you can keep on extending this. Yeah. What's the fundamental of Yangzijiang? Yeah, I think we just mentioned. Yeah, thanks for that. What's the fundamental view on call? So for Citrum, the stock is trading like 40 times PE. So this is a trading stock. I mean, to be blunt about it, it will trade along with the movement of the share price movement of oil price. And if there's any sell down, then you know they're going to get some new contracts up. So there is at least 2 to 3 more FPSOs coming up. So when the news flow come out, you will get this bump up. But is this a fundamentally strong company? I'm not so sure, because even with 8 billion revenue, their margins, I think you mentioned only like 2-3%. So fundamentally, they just have a issue. They just don't have the cost structure. They don't have a profitable cost structure when they're taking on these projects. Yeah. So that's our general view. But again, these are trading stock. People use it as a proxy to oil price. So oil price down and the stock just go down. So we're not very positive on it. Oh, sorry, Corning. Corning is a US stock. Also, sorry, I'm not sure if anyone else in the team knows about this company. I don't really have a view on that. I normally look at Singapore stocks inside. Yeah. Okay, so let me get back. Sorry, there's a lot of questions. Based on your reasoning for Yangzijiang Financial, is this still justified 60 cents? I don't really see the justification. If I'm going to, one thing good is that they are doing a lot of share buyback. The balance sheet is all cash, because if you're buying Yangzijiang Financial, you're buying into the whole Chinese financial sector. I think, like I mentioned before, you're technically buying a bank. I don't mind buying it at maybe if it's 7% yield or 8%, because I know your earnings is going to come down. It's only being supported by the management returning capital. So that's my rationale. At maybe 8-9% yield, I don't mind taking on, because my alternative is a Chinese bank, state-owned Chinese bank that's giving me similar, if not higher yields. Okay, sorry, there's a lot of questions. Hi, Paul, for Raffles Medical, do you feel the foreign medical tourism bounce is sustainable? I don't think it's sustainable for me. I think a lot of patients, Indonesian patients, are going to Penang, going to Malacca, and they are also trying to retain the patients. So Indonesia is inviting foreign doctors, not because they love foreign doctors, but they are trying to prevent doctors from leaving Indonesia. So, and Indonesia is the big market for Singapore. We still have a position for very high-end procedures. But my worry, that's why my focus was so low for Raffles and wrong, was because high-end procedures tend to be taken up by the Parkway Gleneagles, because they tend to take up more of these really high-end cases. So that's why I don't think the bounce is sustainable, at least for me. Yeah. UMS, what's your going forward on Frankfurt? Yeah, so sorry, I just didn't have time to go through all of them. But we will do a film on the ground next week. I think AEM we mentioned. Yeah. So for AEM, near term is still going to be weak because you got this Intel the uncertainty over Intel, and their guidance was weak anyway. So we think, but longer term is still really for me, they done a really amazing job to get such a big customer base. Yeah. So just that near term, I don't think the market can rally off what they mentioned about the guidance. And it's not only one quarter, it's about first half. Will the upcoming CDC vouchers be positive for Sheng Siong? Yeah. In the past, Sheng Siong said that the $150 voucher, that $300 one, won't really benefit because consumers actually just buy better things. The amount they spend more or less the same, but they just better quality. But they also not sure. But for me, I think it will definitely move the needle because $600 is different now. I mean, you're talking 600 to 800. The SG60, and the government's throwing $2 billion into the economy through SG60. So for me, I think it's definitely a positive. Although they can't give a real hard answer because they're not sure how consumer behave, whether they just spend more or they're just using this as a replacement. So for me, I think if each individual is 600, it is much bigger than the current $300 per household. So you do the maths, it's like, I don't know, 10, I don't know, several times more, sorry, depending on the number of people in the household. So it could be like, I don't know, 7, 8 times more in terms of the amount. So it's definitely a positive. Just that we can't give a number to it. We just can say it's positive because sorry, and okay. Do you cover Yangzijiang? Yeah, I think we mentioned all that. Comment on Hawkew's results, please. Yeah, I did have a quick look on Hawkew. Actually, the numbers were actually quite very impressive, the Hawkew numbers, because there was actually some bad debts, but they actually they even with debt also they still grew the numbers strongly. So it's quite an impressive number. Is CDL gearing a concern? What's the fundamental view? I think no issue on CDL fundamentally. I mean, the recent project that they sold at 2007 at Tua Payoh, and that almost sold out. So no issue. The problem with CDL has always been returning money to shareholders. I mean, the deep value. So now it's even super deep value. Even at $20 RNAV, the value of your assets is $20 per share. Your stock is for something. You're not returning anything to investors. So a lot of investors just got, I mean, lack of better word, just got fed up. It's like, you're not giving a nice yield. You're not returning any share. Everybody is buying back share. You just tell everybody, hey, my share price is $20. It's nice to look at, but nobody want to look at the share, right? People want to get money from the share, not to go and keep on looking at $20 value. Yeah. So the problem is just it's a very deep value, and they don't. And with this dispute, I'm not sure if the value is gonna come back. Yeah. So so I really fundamental not an issue, because property market in Singapore is so strong, and investment properties are doing well because the rental reversions are still rising, like all the office. It's just that when you keep on hoarding money, but when you going to give us back, yeah. In view of the tenants pulling out from the 4 data centers, US comments, what are your opinion? Yeah, I think that's the problem for Mint. I didn't cover it because I didn't go listen to their call, but I think Myanmar's feedback is that the data center somehow Singapore is unreal market. Just that there's a scarcity of supply, but in the US there seems to be a larger churn in data centers. So sorry, CK, I don't have a really good answer for you because I didn't really go through. I think we have to wait until when they are back, Darren and Mel. The same question, mean drop below 2. What's your view? My view is don't touch it. Might as well just buy a bank. The bank giving you 6% yield. Unless they hit like 6-7% yield, then I don't see any reason to buy a domestic a REIT that is relying on the local economy. Because if the US rates are going to stay stubbornly high, then I'd rather buy the Europeans and the which I think the ECB already mentioned they're going to cut rates. Cut rates even more. Any updates on Stonebank? So Stonebank, Myanmar attended. She said it is still positive. The rental reversions is up almost 3%, and the occupancy is holding steady at 95%. And they are still looking at strong rental reversions for the logistic business. The reason why the DPU is down, the headline DPU, is because they sold one asset and they are refinancing their bond to higher. So once this is over, we think dividend can grow back, but you're probably looking at the end of this year. But in the meantime, they are still paying a yield of 9%. Yeah. And you have the ECB cutting rates, so that's why we still like Stonebank. Okay, yeah, there's this question on Trump crypto reserve. Sorry, I not very familiar. I need time to go and understand this. Yeah, so sorry, I don't know how to answer you for this. Trump's crypto reserve, is it really viable? I really not sure though. Sorry, I don't have a good answer, so I better not go and give the wrong answer. Yeah. The next one. All the increase in business costs due to progressive wages will be eventually passed on to consumers like us, yeah, resulting in cost of living going up. Not every business can shoulder the additional cost forever, I feel. Yeah, I think you're exactly right. I think that's why most of the F&B companies, you'll notice the earnings are pretty sluggish. Apart from Old Chunky, because Old Chunky, they raise the curry puff 20 cents, which is a lot in percentage, but no, most of us don't feel it. So very few F&B retail can pass on the cost. I think for Sheng Siong, they can pass on the cost because their gross margins for the fresh food, which is meat, chicken, fish, all that, is something somehow the competitors cannot replicate. I did hear it from a competitor before. That is the fresh food business is something they just cannot replicate what Sheng Siong does. Yeah, because it's very management intensive, very good distribution. Sorry, Darren is not around. Hi, Paul. I noticed many companies raising dividend payout ratio, special dividends, capital return measure. This result, good sign for Singapore stocks. Can we expect more going forward? Yeah. So I think I think we can. I think a lot of them are, I guess, fed up with their share price, so they're returning a lot of capital. Not everyone. The old money, I don't see the old money doing that. But it's definitely a positive sign, and it is so the thematic for the next few quarters is it's like the giving pledge, you know. It's like banks are giving back money, a lot of corporates also giving back money, government also giving you money. So I think and also giving you money through the stock market. So I think this year Singapore equities look healthy at least, and it can at least shelter from if there's any trade war coming up. Yeah. What's the drivers? Yeah, I think for Wilmar, I think it will be definitely a bit better this in 2025, because most of the data like crush margins, refining margins are stable. I wouldn't say great, but palm oil prices up, so generally more positive. But I think investors rather just buy a pure palm oil company for now, unless China consumption is improving. Because my guess here, I think 20-30% of the business still comes from the Chinese consumer, which is their which is the Awana fish brand, the branded cooking oil. For Sheng Siong to grow forward, would they have to gain share from FairPrice, the biggest competitor? Is there any sign of that? I don't think it's FairPrice. I think they just have to take share from Giant good enough. I think they mentioned Giant has 40 stores. I'm not sure how many is HDB. I really don't know. I'm not gonna. Yeah, but if you assume 20 is still a lot, because Sheng Siong has 75 stores. Even taking over all the Giant stores is also a big growth for them. Yeah. I don't have to take on FairPrice. Yeah. Because FairPrice has some in the supermarket, whereas Sheng Siong is only HDB. Yeah. What's your view? Yeah, what's your view, Tiger? No change in my view. Yet I'm not a big fan of Semcon Industries because the dividend yield is still so low. It's about 3% in your utility. Just that I have to hold my comments first because we're going to issue a report. They just have to wait 1 to 2 days because just the work. I've got like 6 to 7 reports to do. So just hold on for us to give a comment. Sorry for that. Okay, I think I'm hand over to Zane first because we're hitting across the 12:30. Yeah, sorry for that.
Thanks for, I'll take on the TA questions. Okay, so first question is on iFast. Okay, for iFast, I feel that it's quite volatile recently. Price is trading above this uptrend channel that it has mostly traded in since April last year for now. And then there was also this very long lower week on Thursday itself, where price actually touched 793 and then it came back to about 660. So I feel that for now, short-term wise, is probably a bit overbought. I think I'm expecting a bit of a slight pullback in terms of moving averages, also currently below the 5-day MA. On 5-day, we have this like the bearish candlestick as well that covers the Thursday's candle for the body of the Thursday's candle. So I'm expecting some pullback to take place. Near-term support wise, probably around 810. There's some support over there, which was our previous resistance. And next up for CK Infrastructure. CK Infrastructure, overall very range-bound counter. Recently, some bounce after breakout this short-term downward resistance line, but some resistance still holding a lot of resistance around $54, $55. So for now, a bit of a slight pullback. I think price could do a retest of the key support again, which is around this around $50, 51 level over here. That also has this key our support line. So confluence of supports over here that price could actually come back. Next one is XPeng. So for XPeng, short-term wise, still quite strong as it broke out above this trendline resistance over here around $72. Then in terms of the short-term trends, still quite, I think we're still seeing strong bullish momentum. Price is still holding up at the 5-day MA is around $81 for now. So I think as long as this level can hold, we can perhaps still see the upward trend movement continue. The next key resistance, I would think it's somewhere closer to 96, this swing high over here. Yeah, so that's for XPeng. As long as the price continue hold above $81, then I think perhaps price can still go upwards. Yeah, so I think I'll comment on the GLW, which is Corning from a TA perspective. For Corning for now, I think overall is still in an uptrend. Recently looks like a bit of a range consolidation, some slight weakness with this lower highs, but key support is still holding around. Sorry, $48, $49, which was the previous range resistance. So I think looks like a short-term double bottom, increased volume as well last Friday. So I think still okay. Perhaps a bit of a range consolidation for now. Resistance probably around 51, around 51.60 about there. So some consolidation. As long as it doesn't break down 48, I think it's still okay in the short. Yeah, still just moving sideways for now. Okay, then next one, some TA questions on Singapore stocks. Yangzijiang Shipbuilding. Okay, for Yangzijiang, I think for now I'm still a little bit more towards the bear. I think it could still go lower because in terms of the trend, I think it dropped over $1 from the peak over here, and then this blue trendline support, which is quite important, I feel, which helped price a few times. Price was holding over here, but still closing below. So as long as price is still below like 240, around 247, 240, I think there could be still some bearish bias. So it's below the 5-day MA for now. Yeah. Then so I think it's still some risk. If there's still some reason we at least around 247, 248, the price could still come back to retest the recent low around 224. 224 was also a previous double bottom over here. Yeah. Then I think some interesting thing I saw on the monthly chart also is that previously Yangzijiang during the rally since 2021, 2022, price has always maintained above the 10 MA on the monthly. But with the sell down, I think especially end of last month, there has been a breakdown over here. And also coupled with the RSI being overbought, coming back towards a neutral level. So I think that it's starting to see a bit of a trend reversal taking place on the longer term as well. So we could see a slightly more weakness if price can't get above some of the recent levels. Yeah. So that's for Yangzijiang. Next one is stats. So for stats, I think for now still maintaining this downtrend channel over here. A bit of a sideways movement, lower volumes after these 2 days of a high volume sell down last week. So I think that might do a bit of a consolidation for now. This 310 level was a previous key level as well, so it might just go sideways over here. Price is still facing resistance for 5-day MA. So unless it can break above like 308 to tomorrow or next few days, then there could be some slight recovery, but likely still trading sideways for now. This one's Samudra Shipping. So for Samudra, some price weakness after price was unable to hold well above 92 cents, this key resistance. So there's this spike then on high volume harvest, subsequently just came reverted back downwards. So also below some of the short-term moving averages. So I'm expecting some perhaps a little bit of a further downside since if you can't hold this 87 cents level over here, it could come a bit lower, maybe perhaps towards the next support is around 85 cents, about that 85 cents and 83.5 cents. So it might come back down to these two levels. Then for Apple, I think Apple, this one just didn't really move much as compared to some of the other names in the SGX. So just still sideways, key resistance to break is still around 690, but looking still positive, I guess, with the recent higher lows being formed recently, and I see the MACD is also still remaining above 0 line. Also still okay. I think for now, just need to see whether it can break 690, then perhaps we could see some upside. If not, just if it doesn't break 690, then we will just likely just move sideways again. Then next one is Mapletree Industrial Trust. Yeah, so this one is still rather weak. Yeah, below $2. So I think with that, likely to see the very trend continuation downwards. To the next key support area, that's around 190 to 193 area. That's the next key support area for now. So I would expect price to still continue a pullback. Next one is on Penn United. So for Penn U, I think overall is transitioning to a bit of a sideways consolidation. Previously, there was a steady uptrend and price spike upwards. For now, it's just in the range consolidation between like 59.5 cents to 65 cents. So I think for now, there's some resistance around this 63 cents area. It was a sideways before there was a breakdown over here on a bit of a higher volume, but this swing low still held as support at 60 cents. So when come back over here, I think there's still some a bit of resistance over here. Just maybe some sideways in the meantime. Yeah, then see whether it can form a higher low as compared to 60 cents, then perhaps you could test the 65 cents level again. Okay, then for WeHer, for now, WeHer it's a bit of a short, weakness since they broke down this upward support line over here. Already as of today, there was a gap down testing this support level around 43.5 cents, 44 cents area. So need to see whether there's some support that comes in over here that holds a bit of about price for now. But I will still expect price weakness overall, given the breakdown of a few levels all the way like 52 cents, 50 cents, 47 cents. So short-term resistance will act around 47 cents around there. And price is also below the 5-day MA as well. I would think key support that could hold the price will probably be around 41 cents, which was over here, this dip over here, and as well as a few dips. So this is a key support level that could hold the price if you come back to this level. Okay, next one is CSE. Yeah, for CSE Global, I think overall it's very still slow and steady for now. So overall, the big picture is that it's a range between 41 cents to around 49 cents. Then slowly, recently, it's climbed upwards. We have a series of higher lows, upwards trend line support over here as well, 45 cents resistance turn support. So I'm still positive. I think we'll still slowly inch upwards to test this around 49 cents horizontal resistance slowly for CSE Global. And for Delphi, I think overall it's a downtrend. Recently, price is in the range consolidation, so we might see still some consolidation take place. Key support to hold 72.5 cents over here. Short-term resistance will be 75 cents and 78 cents about there. So I think just still some range consolidation might take place. But if it does break below this support at 72.5 cents, then the next level it could test is probably 70 cents, the next support level downwards. Given that overall it's still in trading in downtrend. Okay, then some US counters. First up is Alphabet. Okay, so for Alphabet, last week had a pullback below this 174 was unable to hold a support, this gap fill over here, and came all the way down to about 168. So 168 was this previous horizontal recent level as well. Over here, there might be some bounce if it's able to hold this level. Short-term resistance will come around 176. It's still below 5N, so there's still some weakness. Yeah, I would think a strongest support might come around 162 about there. So this is the previous range support level here that is confirmed with this very key uptrend support line that has helped price since October 2023. So this is the line I'm looking at that could provide a good support about 160s. Then next question is on Microsoft. So for Microsoft, I think it has come back down to a key support level around 385 on Friday. So this was like this dip over here as well as this previous gap down back in August last year. So price will do a bit of a bounce on this level, but overall I'm still expecting weakness. Because that recent price actually broke down below this trend line support around here around 410. So some resistance will come around 405 to 410, this area over here, where previously this was a very strong support. Now we will turn into a resistance. So I think expecting some bounce, but still a lot of resistance in the near term. Yeah, for Microsoft. Okay, then for Chubb, I think Chubb is a bit of a bounce for now, but it's slightly just doing a retest of a uptrend breakdown. So previously it was trading in this uptrend channel here, then there was a breakdown. Price started to do a bit of a sideways consolidation, breaking above the 280 neckline resistance over here. So I think as long as this level holds, you can expect a bit of a bounce, but some resistance are 290 to 296 about here. This area is key resistance. I will still likely where price will still likely face some rejection from if it does retest this uptrend channel in past uptrend channel breakdown. So I think could still see a bit of a slight upside, but some result ahead above 290 to 296. Okay, then for Nvidia, I think Nvidia's chart is also quite interesting. So for Nvidia, I think the keys is again back to this key trendline support over here in blue. This blue trendline support is the key to maintaining the uptrend. So it's tested multiple times during the dips in the past. As a DeepSeek also it held at this level and recently still holding at this level as of Friday. So I would expect some bounce to take place, but 130 is some 130 to 135. This area will likely be a resistance because 130 is a very key level over here that's switched between support and resistance in the past, and 135 is also like a breakdown level recently. So some bounce, but resistance ahead. Also, generally in the short term, I feel that it's trading in this downtrend channel over here. So it might just continue lower highs and lower lows. Yeah. Then for NVIDIA, I think you need to take note if it breaks below is 118, then we might see some downside towards like closer to the lower end of this channel. Yeah, so let's see. Let's continue to monitor. Let me see what are some other questions. There's question on some REITs for Pacific Oak. Or for Capital Pacific Oak, I think overall big picture is trading between 20 cents to 27.5 cents about that. Recently, a bit of a price just pulling back. Yeah, so I think we might still see a bit of a sideways, a very slow kind of movement, sideways, might pull back a little bit further if it does not test 20 cents. I think this will still hold as support, but resistance will likely come from the recent breakdowns of 22.5 cents to 24 cents area over here. And this one is on Prime US REIT. Okay, Prime, I think it could do a bit bounce from this level. So this is a very key support area around 14 cents is currently back at. So this area, you see about if it does close above the 5-day MA over here, I think you could see some short-term bounce upwards. Resistance likely for now could come from the 10-day MA around slightly above 15 cents about there. Yeah, so I'm expecting some slight bounce for Prime at this current support area. Okay, then for Mapletree Logistics, I think it's just moving sideways. So I think that will still continue for a while since it doesn't have a very clear trend in the short term right now. Key support is still a 118 to 120. Resistance ahead is about 127 to 130. So it's just moving sideways since November of last year. I think that will still just continue for the time being. Then there's a question on YZJ, which is Expand Energy Corporation. So for this, I think possible short term would more weakness in the short term because price actually broke down of this uptrend pattern over here, move sideways, a double top at 109 and break below this key support at 100. Also psychological level last week on high volume. So I'm expecting some further weakness for price to come down towards like 90, around 91.50 to 94 area, which was this previous resistance, also this swing low support. And this one is on U10, which is UBKN. So for UBKN, I think overall still an uptrend chart. Recently, there's some, I think for now there could be like some shorter weakness as price was unable to hold above 189 this level at this breakout on high volume. So high volume, but price subsequently came back down again. So there's some likely means that there's some traders that actually took profit at the higher levels and wasn't able to sustain the trend over here. So this support level still holding 179 this dip. So I'm expecting some range consolidation with resistance still coming around 190 this area for now. Yeah. Okay, then there's a question on CTF services, code 659 on Hong Kong Exchange. Okay, for CTF services, overall, it's upwards trending. Recently, a bit of a range bound kind of movement. Key support still around 720, recent resistance around 820. So there was also a gap up over here. So I think for now, it's also quite near the top end of this range. So 820 still likely to hold resistance. Let's see whether, I think the key is to see whether this 770 to 780 area can hold as a support. If it for now looks like a bit of sideways consolidation might come as price, we don't see price going out one shot to test the resistance. So it might just sideways over here around 770, 780. Then if it can hold as this resistance can hold as support, and I think it might go up back up to test the top end of the range resistance. The next one is on Nam Chong. So for Nam Chong, I think overall it's in a bit of a range consolidation between largely 50 cents to 59 cents. Some slight weakness where price tried to break above this 56 cents level, high volume, but just reverted back downwards. So I was unable to hold the breakout. So we might still see some resistance above this level in the short term. So for now, maybe still some consolidation might take place. But as long as price is still above this breakout level of around 50 cents previously, this previous resistance, I think overall the uptrend is still intact. Yeah, it might just continue to consolidate for a while. Okay. Yeah, I'll just take the last two questions on the TA since it's got one. So for CDL, currently today, it opened at one of the support level around 484 and there's some rebound taking place. So I think we might still see some resistance above $5, which was previously the very long consolidation over here. So I think this support might turn back to a resistance. And overall the stock is trading in the downtrend. So I think any bounce over here back to the old supports will likely be met with resistance. Now below 484, the next key support I think will be around 455 if the price ever goes there. Then for UOL, for UOL, I think it's for now in the short term is still okay. Long term is still downward trending. Short term is looking a bit of a sideways consolidation. Price is still holding a bit of a higher low. Recently formed around 524 at the previous horizontal level. So as long as we can continue to form higher lows, trend along above the 10 MA, which is support around 530 for now. I think it might still try to go upwards. If you can break above like 550, then next resistance will be around 560 to 572, this area over here. Yeah, that's for UOL. Okay, sorry, I'm able to take all the questions in view of time. I'll just hand back to the rest of my colleagues if there are any more questions to answer. But you can feel free to post your TA questions in the our Poems 3 community group, and I'll answer it over there. Thanks.
Oh, okay, thanks. Let's try to wrap up as much as we can. I think someone asked you to put on the ETF monthly again, right? Is it? Sorry, Zain. Do you agree with JP Morgan analyst downgrading a Mapletree? I'm not sure if Myanmar can answer that. Nick mentioned Trump will set exact levels of Mexico-Canada tariffs. Do you feel it will deviate? Yeah, I think even if it deviates on the 25%, any tariffs is going to have a damage on the whole outlook for global growth, because even if it's 10%, 15%, Canada will also impose the other 10-15%. And it's going to cause a lot of worries about inflation in the US, global growth in the whole economy, because the next target Trump is going to go after is definitely Europe. So the way the way he sticks with Zelensky is like almost talking to Europe. So that's the worry, that this is just the first shot. The amount isn't, of course, lower, it helps, but so long as he imposed tariffs, it's going to be quite damaging already. Yeah. I think the read-through will hit other countries. First Resources, Bumi, Tama. Yeah, I would let me get back to you. I'll try and do film on the ground to give an answer to the First Resources and Bumi, Tama. Sorry, just that. That's too heavy. Any thoughts on the CDL price outlook with the recent father? Okay, if for us it mean the problem is that even if the saga is improved, does it really change anything on the company giving us providing shareholder returns? Their dividend is 10 cents, it's like 2% yield. I'm not sure why they want to give a dividend. I myself don't give 2% yield. 2% yield is quite insulting actually. So I don't, even if the saga is resolved, I don't think it's going to change anything unless they change their view about returning shareholder capital and not just talking about the $20 is so fantastic for them. So even if people might just buy, people seem to be buying UOL or other stocks to play on the property sector, yeah, or even Guoco Land rather than buy them. Yeah. Hi Paul, for PropNex 21st anniversary, is it this year or next year? Yeah, is this year 2025? I think July. They said they're going to the celebrations on July. I do not know what that means, but anyway, that is the exact month, maybe the July this year. Hi Paul, any news on micromechanics price seems to be drifting down. I think the outlook has been a bit better. And the one thing unique about micromechanics is that they have capacity in the US. So if everything, all production going back to the US, that might help them a bit. I'm not saying they are cheaper than the rest, but having a presence in US might give them an advantage. They did say that there is a recovery coming back, but I just can't give you the level. But the worst is definitely over for them. But why the share price dropping, I think, is in line with all the semiconductor stocks. With the current situation, is it a good opportunity to buy CDL now? I don't think we'll change our guidance, but again, you can buy on the sentiment of the dispute now being resolved. But apart from that, like I said, I worry there isn't really change in their view on shareholder return. I mean, yeah. Has the outlook changed? Yeah, I don't. Fundamentally, no change. Like we mentioned, we did double check with some real estate agents. They just say that their ORI that they sold in Toa Payoh is 88% sold. So I don't think any change in people's view. People just want to make money from the properties, but not from the share price, I guess. Ames APAC, I think I hand it over to Miao. Aztec, I hand it over to Yikban. GL Conning, sorry, I don't really know much about the company. Yeah, apologies. Yeah. And OCBC, I hand it over to. Let's try and wrap it up. Yeah, thanks, Evan. Miao and
Hi, yeah, for Aztec, they didn't have a analyst briefing these results. Yeah, so and we don't cover them as well. So I think overall the results are quite negative, minus 60% year on year. But I think they try to give special dividends in order to reward shareholders because they have quite a lot of cash. But I think overall outlook still not very good for Aztec. Yeah, thanks.
Yeah, I'll take the IMS APAC. So IMS APAC, there's a current reversion of around 21% on last quarter. And they are actually in the middle of backfilling the empty space vacant by DHL. Yeah, and they target around 20% rental reversion for the new list. And rental reversion guidance for 2025 is still positive. Going to be at around 20% range. But they do say like new supply is coming up into the market. And yeah, but rental reversion is expected to stay steady this year. Yeah, hope it answers your question. Thank you.
Yeah, there's one on the OCBC. Not very sure what the question is. I think I said it already earlier. Yeah, the question is OCBC, which good to buy? Yeah, our choice for the banks would still be UOB if you compare the three local banks. Yeah. Okay.
sorry, Myanmar, can you comment on? Sorry, Grant. Can you comment on the Cecil read one? OUE read.
Sorry, I don't see the question. Do you mind read it out?
Any update on OUE read and Cecil read? Yeah.
Oh, okay. So for OUE rate, their outlook for the hotel sector is pretty muted. Yeah, given the increasing supply in the market, but their forward booking for January for the first quarter is still pretty strong. And but this year F1 is going to be overlapping with China's Golden Week. Yeah, so with the elevated hotel rate, they do feel like there will be less Chinese travelers returning to Singapore. And they divested the only overseas properties, Little Plaza Shanghai. Yeah, so they're now like pure play Singapore. Yeah, so we do expect that to improve the valuation, like in general. And for Cesar rate, Oh, we expect tenant sales in 2025 to be flattish. But even though like they do have a lot of promotional events going on, but the general consumption trend in China is not as good as expected. And people are spending less on the international brands, which is actually generating like higher dollar value for accessory yeah in the past. But now since like they're shifting towards the Chinese domestic brands, yeah, so we believe like tenant sales this year will be pretty flattish. Yeah, but they have a lot of like cost saving on the financing part, since like they are taking more onshore loan and targeting to around like 60% by the end of 2025. Yeah, so with like LPR trending down, we do believe cost of borrowing will be decreasing this year. Yeah, thank you. Hope it answers your question.
Yeah, thanks. Yeah, someone said I referred to Miao as Myanmar. Sorry, it is hopefully not, because Myanmar is a dangerous place right now for Chinese people. Yeah, but anyway, thanks for the comment. And thanks everyone for your questions. There's one on outlook for EXE. So sorry, I'm not very sure what EXE is. And there's one more TA on Mapletree. I think all this for US. I think Zane has an event every Monday 8 p.m. No, just look at you can dial in and he can give you TA for that. Yeah, just go to our POMS education or events page, and then you can sign in for that every 8 p.m. on Monday. Yeah. So with that, thanks everyone. Sorry it overran overran 1 p.m. We try to answer everyone's questions, and hopefully it was helpful. And thanks everyone for your time and spending time with us. And thanks for all your questions. Thank you. Bye bye. Yeah, thanks, CK. Right.